Says yes.
Yes.
In the exam? Yes, because each transaction will have a number or a letter.
Are you going to be doing general ledger and general journal?
Yes.
Okay.
I would count on it. Okay? Other questions? All right, moving on. Chapter 6. Chapter 6 is revenues, receivables. Cash gets thrown in at the end, but it's basically revenues and receivables. So we're selling things on accounts receivable, right? Or accruing some sort of revenue. Okay. So, in order for us to have a sale, there's some rules under GAAP. Four criteria need to be satisfied. Not one of them, all four of them. First one is pretty obvious. Have we given the product to the customer? Right? Customer comes in, if we own a bookstore. Have I made a sale if I still hold the book? Have I sold you a book yet? No. Now have I sold a book? Maybe, maybe not. I'm off to a good start though, right? The second one is, have we made an arrangement for you to make payment? Have you agreed that you're going to pay me? If you've given me the cash already, yeah, this is pretty much taken care of. If there's an accounts receivable where you've signed on the tag saying, yeah, I promise to pay you later, that takes care of this as well. The third one is the price fixed? Do we know what the price is that you're going to pay? If we've done a tag where you've signed saying I'm going to pay you, it'll have a price on it. So at that point, there's evidence that the price has been established. Prior to that, what if I just say, hey, pay me $20 next week? Well, that's verbal. Is that strong enough? Yeah, maybe, maybe not. The fourth one is, am I ever going to see the money? I gave you the book. I know that we've got an arrangement. You are going to pay me. I know how much you're going to pay me. Are you good for it? Can you actually make the payment? If I sold the book to Louisa, I'm pretty sure I'm getting the money. If I sold the book to him, I'm done. I'm never going to see it. I know it. Okay? Well, it's easy to pick on you. Yes, sir.
So the price fixed or determinable, could that depend on the type of sales you're in? Say if you went into a hardware store and you wanted to buy an item, that's like a hammer is going to be a fixed price.
Yeah, the price is...
If you went into like a pawn shop, and they can kind of make the price up. Okay.
So if there's a price list, and you're going to buy, a truckload of, I don't know, awnings for buildings, we're using the price list, right? But if you walk into a pawn shop where you're going to negotiate with the guy, the price isn't fixed until you guys write it on the piece of paper, really. Okay? Other questions? All right. Credit card sales. For some reason, people get confused at this one. A credit card sale is a sale. It's not an accounts receivable. That's the one where people tend to get a little confused with it. Think about it. If I run a business and I accept credit cards and I run the card through my machine, do I get the money right then and there? No, I get it like the next day from the credit card company. But for all intents and purposes, I know it's coming. All right? So it's not an account receivable from the customer. At absolute worst, it's an accounts receivable from the credit card company. Most people don't ever record it that way because the following day you've got to do an entry to change it from accounts receivable to cash. It's a whole lot of work. Most people just record them as cash. So the point behind credit cards, though, is we all know that the credit card companies charge a fee, right? So if I'm selling you something for $100, I'm selling you a book for $100, why do I want to give up 3 or 4% of it? Well, it makes it easier to sell you something, right? You're more likely to, maybe you don't have $100 cash, but you got that credit card. Bang, I made a sale as opposed to I made no sale. Also, if I accept a credit card, maybe I don't have to accept an accounts receivable from that guy, right, who I know isn't going to pay me. Then it's the credit card company's problem if he doesn't pay. Anybody take checks anymore? Right? You almost don't see them. But stores don't want to take checks, because what happens if the check bounces? Then they got to come find you and hassle you to get paid, and it takes a whole lot of work.
Automated, they scan
Yeah.
the bank account number and it's taken automatically out.
In the modern world, they run them through that little scanner, and it's almost like a credit card where it goes zip, and the money's coming. Okay? Fraudulent credit cards, that's on the credit card company. You don't have to worry about that. If I take credit cards, here's the big one. I get money from the credit card company a lot faster than waiting for you to pay me in 30 days. So it speeds up my cash flow. Remember, cash is very important. Well, if I don't have cash, can I pay my bills? No problem. Okay? All right. For those of you who've seen this before, help me through it. Leaving credit cards behind for a moment. If I sell you merchandise on terms implies I'm giving you credit. It's an accounts receivable sort of thing, correct? Okay? Accounts receivable, I give you terms. I tell you you can pay me in typically 30 days. On the invoice, there's going to be this little code. And the code has meaning. If you just see the thing say N30, that means you owe me the net amount, whatever the invoice was, in 30 days. Okay? So if the invoice is for $100, you owe me $100 in 30 days. If it says something funky in front of it, like 2/10, that says you get a discount if you pay me in 10 days. And if you don't pay me in 10 days, you owe me the whole thing in 30 days. Okay? 2% off if you pay me in 10 days. So you pay $98 instead of $100. Or you wait till 30 days, you pay me $100. Good? Okay, so you know how to read that. Often called 210 net 30. 210 net 30. Yes, sir?
Does that appear like on contract? Or?
It's on your the invoice when you sign for it at the store.
Oh, okay.
Okay? You walk out with the merchandise and a copy of the invoice, and they put it in their system that you owe them money in 30 days. Okay? So, should you pay in 10 days or should you wait and pay in 30 days, right? Money's important. Hang on to your money as long as you can, yes or no? Who thinks you should pay right away? Who thinks you should wait?
You own, right?
What?
It's on the amount you own.
Depends on if you have the money and if you want to save a couple bucks or what you have.
If you have the money, pay it. All right? If you do the math, let's say it's $100 like we were talking about. If I pay it in 10 days, I pay $98 instead of $100. 2 divided by 98, that's 2%. It's, right, a little bit more than 2%. Because you're working off of the amount of cash you actually paid. Now think about this. If I pay all of my bills every 10 days, how many times a year can I do this? How many? How many days in a year? 360. So I could do this 36 times. If I earn 2% discount 36 times a year, in essence, I've earned how much of a discount?
37.23%.
There you go. Now, when are you ever going to earn a 37% profit on your money? You're not. Take advantage of it. It's big bucks. So you're starting to see companies not offering. 2% net 10 was very common long ago. You don't see that hardly at all anymore. You see 1% sometimes, and a lot of companies don't even offer it anymore because it is such a huge discount if you do it all the time. Okay? But that's the power of compounding. Take advantage of it. Good? All right. All right, returns and allowances. We've talked about sales before, yes? Pen is not in my pocket. All right, returns and allowances are contra accounts. So if we have sales, let's go up and do an income statement. Revenue, section, sales. Let's say I sold $100 worth of stuff. Good. But I have returns. People brought back stuff. Say they brought back $10 worth of stuff. So I really, at that point, only sold how much stuff? $90 worth of stuff. But let's say something like you're shopping at Macy's and you're buying a sweater and there's like a little ink spot on the wrist. Well, you'd rather have the new one, but they'll sell it to you half off. Well, maybe you'll roll the sleeves up and pay half price, right? So sometimes you have these discounts. So if you give somebody a discount on something that's maybe damaged or has a little ink spot on it, you're discounting your usual price. And in this case, our net sales isn't $100 at all, it's really only $80. And it makes a big difference. When you're in retail, returns can be a significant cost to you. Think about walking into any store in the mall on about the 28th of December. Okay? People are bringing lots of stuff back, right? So all those people that are working, a lot of their time is dedicated to this. They're not earning revenue. They're just a cost to take stuff back. So you want to know what your returns are because it affects your costs. And discounts, how good are we at managing our inventory? How much of our inventory becomes old stuff that, gosh, it's summer now. Are people going to come in and buy those thick winter coats? Better put them on sale, right? I got to discount them. So maybe our buyers didn't do such a good job. They bought too much. It helps you evaluate how your internal processes are working. That's why they get tracked separate in their own accounts. And I'm going to answer your question, but so these are related to sales. They're connected at the hip, so to speak. You know how we have an asset like trucks, and then we have its complementary account, accumulated depreciation. They go together. You add them up. So we're going to have sales that has a what balance? Credit balance, right? And we're going to have returns that has a debit balance and discounts that has a debit balance. And you have to add those three accounts up to get what your true net sales are. Good? So what was your question? Okay. Anybody else? Yes, ma'am?
Are we ever going to be covering delinquent accounts?
Yes, we will.
But not now? I'm trying to figure out where it's going to fit in.
Hold your breath. Give me a moment. Okay? Moving on. So, yes?
What about the damaged merchandise?
What about how much merchandise? Damaged. Well, that's part of the returns. I'm sorry, the allowances, the discounts. These were damaged, so I gave people a discount to buy them.
But those that are totally destroyed.
Oh, then that is something that is just a loss. It's an expense. So it doesn't go in a sales category at all. It doesn't go here. It goes down in expense. Damaged merchandise, out. Okay? If you're throwing it in the dumpster, it's an expense.
What then is the difference between the discounts and the allowances? I mean, I thought the allowances were like when some...
We're going to get there. We're going to get there, yes. So it's typically called discounts and allowances. They're thrown together. So I'm trying to present the discount concept here. An allowance is different in that you ever heard of tiered pricing? So Sean comes in and she buys $10 million worth of stuff from me a year. So I'm going to give her a price that's, instead of charging her $100, I'm going to give her, let's call it regular pricing is $100. I'm going to have Tier 1 pricing and Tier 2 pricing. Tier 1 pricing, you only charge them $95, and Tier 2, I'm only going to charge them $90. So she buys $10 million worth of stuff from me a year, I'm going to give her a lower price. If she only bought $5 million, I'm going to give her a different price. And if she just walks in off the street, she pays full retail. So this is kind of a volume discount sort of thing. That's an allowance I'm going to give her right up front, just because of who she is.
Well, they're saying that it's returns and allowances, and then discounts are separate, like a separate account from one sales and like returns and allowances account.
Okay, but depending on which company you look at, your general ledger accounts will be called returns. One will be called returns. And then I've seen companies where it's discounts and allowances are lumped together. Yeah, but they're three separate things, and let's talk about them. And depending on your individual company and needs, you may want to list them all separately or lump them all together or some combination. Okay? Yes, ma'am.
So what you have on the board is kind of related for like the retail business. Say you're the seller of the product and the customer comes in and buys it. They're giving them either a refund or a discount on the product. But what if you have a product you want to return to your supplier?
Oh, that's a purchases return or a purchases discount. And that's between you and your vendor rather than you and your customer. Yeah, instead of it being sales discounts and sales returns, it would be purchasing discounts and purchasing returns. Okay? Other questions? All right. Okay, the other fun one, remember we talked a moment ago about accepting credit cards and the credit card company charges you a fee? So take the fee out as well in determining what net sales are. Good enough? Pretty straightforward. Okay.
Question about merchandise.
Merchandise is it's a technical term, it's stuff. The stuff we sell. Okay.
So if you, let's say, you had an entry in your journal where you're doing a return, so that money needs to go to sales, but what if you're also...
Hold it. We're doing a return, the money's coming out of sales.
Yes, coming out of sales. But then what about the merchandise? Would you then add it back into
Goes
merchandise?
back into inventory.
Would you have a separate, like, account instead of just straight merchandise, instead of like merchandise returns? No.
Not typically, no.
It just goes back into inventory.
Right. Unless for some reason you know it's damaged and you're going to throw it away, then it goes in an expense because it goes in the dumpster. Okay? All right. So, gross profit percentage. We figured out what net sales are, right? Net sales are sales, or net revenue. Sales minus your returns, minus your allowance, minus your discounts. Everybody's good with that? Okay. So the next one is, I'm coming over here because I need more board space. Gross profit percentage is net sales, let's say it's 100, minus cost of goods, let's say that's 60, gross profit is only 40. I need that other marker. This one doesn't write so well. Everyone understands what I'm doing here, right? Cost of goods is, here's what I paid for those books that were on the shelf that I sold. I sold them for $100. I have gross profit of 40. From this, I have to pay my employees, my rent, my utilities, all my overhead. And then I end up with whatever's left as net income. Good? So, gross profit is the gross profit divided by net sales, or 40% in this example. My gross profit percentage is 40% in this example. In this example, on the other hand, they've got some bigger numbers. So we had gross profit of $305 million off of sales of $689 million. It's 44.3%. So the bigger this number is, the more money it leaves to pay for your general administrative wages, rent, and all that other stuff. And if you're managing those well, theoretically, the higher this is, the better chance you have of making a higher profit. Okay? So if you look at these competitors, they've given us Deckers, Skechers, and Timberland. 44, 41, 45. Which company has a better chance of making a higher profit? The guy with 45, right? Good with the concept? All right. All right.
Is gross profit percentage essentially the same thing as your sales margin?
Sometimes called gross margin, yes.
Cool.
Okay? All right, receivables. Two different kinds of receivables. Receivables created from the business that we are in, right? Selling stuff that typically becomes an accounts receivable. Accounts receivable, we get paid in 30 days, blah, blah, blah. Customers come and sign for it, take merchandise, and I get paid shortly thereafter. Sometimes referred to as trade receivable. Since we're learning a new language here, let's cover that. Trade receivable, accounts receivable, same thing. Notes receivable, unless I'm a bank, I'm not in the business of lending money. So this is a non-operating expense. This is not from me. This is not the business I'm in. But that's when I go lend money to somebody else and they promise to pay me. And a note is typically for a longer period of time than an accounts receivable as well. This could be 3 to 6 months, 12 months, 12 years, 30 years, whatever. Good? All right. Non-trade receivable. It's not from the business that we're in. So these tend to be current. These tend to be long-term or non-current. But you could have a note receivable that's due in 3 months and it's current. Okay? Questions? We're getting to your question. If I let customers take goods and walk out of the store and promise to pay me later, what's the one thing I know is going to happen? Somebody's not going to pay me. That's exactly right. Okay? Somebody's going to smile, shake my hand, and say thank you, and walk out and never pay me. That is referred to as a bad debt. They owe me a debt. They don't pay it. They're bad. I'm bad for letting them fool me, right? That falls into the fool me once category, right? Fool me twice, then it's on me. So, in GAAP, we've talked about the matching principle before. We want to match the cost of those bad debts with the same time period as when we record the revenue, when we made the sale. There's a challenge with that, though. Anybody want to take a stab at it? What's the challenge? The day I sell you the stuff, how do I know who's not going to pay me or how much they're not going to pay me, right? Typically, it's at least 30 days later before I even have an inkling that they're not going to pay me, which by definition is in another accounting period. Sir?
We could kind of look at previous.
Okay. So what you're recommending is that we're going to make an estimate. Okay. So let's, for clarification, what is an estimate?
Wrong.
Wrong. Okay. We're going to make our best estimate, though, right? So we're going to take a stab at what we think bad debts are going to be, and we're going to record that, and we're going to accrue a reserve so that when we find out how much really becomes bad, we write it off against the reserve, and we don't have to record it as an expense in the future. Good? Okay. Estimate. We're going to make our best estimate. I mean guess. I mean estimate. So, as I was saying, we made some sales. We know that somebody's not going to pay us. We calculate a number. We guess that we're not going to get paid $27.5 million. That worries me right out of the gate, right? I'd be upset over 27 bucks, not 27 million. So this must be a big company. Oh, Deckers. I don't know who they are, but okay. Shoes? They must sell shoes to women because they're kind of pricey, it seems. I got lots of laughs from this side of the room. So we made the sale, and then at the end of the month we're going to do one of those adjustments on our worksheet like we did at the beginning of class. We're going to record a bad debt expense for the $27 million, and we're going to set up an allowance for doubtful accounts for $27 million. Yes, ma'am. No, you can't have $27 million.
So the $27 million that they're saying right there, is that their accounts receivable total?
No, I was just going to draw this out so you could see it.
There's probably a portion of it.
Exactly. It's only a part of it. So we're going to have
$27 million is the part.
sales, and let's say we're going to make up different numbers, okay? Sales are always a credit. We're going to have $1,000 in sales. Good? And we're going to estimate that we're not going to get $40 of it. So I'm going to record an allowance of $40 over here. So my allowance for bad debt is 40 bucks. My sales are 1,000. My allowance is 40 bucks. My accounts receivable, let's say I sold all of this on credit, right? So my accounts receivable is $1,000. Everybody follow me? Okay. Sales 1,000, accounts receivable 1,000. My realizable accounts receivable, what do I expect to really get? 960 bucks. This is another one of those complementary accounts where you have to add these two together to get your real ending balance. So I have $1,000 in accounts receivable, but I don't expect to get 40 of it. So my net realizable accounts receivable is really only 960 bucks. If I show you on the balance sheet that my accounts receivable is 1,000, I'm overstating what my accounts receivable are. Because I'm not going to get that much, and I know that. I've admitted it right here. So I don't want to overstate it. I want to show the amount I really expect to get. Good? Everybody okay with this concept?
Yeah, what balance is out your debit?
This debit?
That one.
Okay, that's this entry here. Bad debt expense. It'd be bad debt expense 40 bucks. Allowance.
So you make a bad debt expense account.
Yeah, oh, and you see what I did here? I put this on the wrong side. How come nobody busted me for that? You know, let me look stupid and not tell me. You know, we're just going to humor the guy, let him do his thing, you know. We know it's wrong, but we won't tell him. I'm sorry, what? The 960 is not recorded anywhere. It's recorded here and here. What you're saying is I'm only going to be able to collect $960 in accounts receivable by adding these two together. On your balance sheet, you're going to have cash, AR, less allowance. Okay, so I'm going to have $10,000 in cash, $1,000 in accounts receivable, $40 here, net realizable 960, and you keep going. So that's how you'd present it on your balance sheet. Okay? Yes?
Like when you're doing the T accounts, you know how you have to kind of balance it out. So say sales is 1,000 and AR is 1,000, but then you have that other category of 40. There's nothing to balance it out.
Hang on. That was his question. It's bad debt expense. Okay?
So much less panic about it.
But where's the 960?
It's only presentation when you show it on the balance sheet. So notice I show this account, and I show this account, and I just do the math and show you the two of them added together. Okay? So if I record my sales, I record my AR. I record my allowance for bad debt and my bad debt expense. And then I present it on the balance sheet like this.
So the allowance for bad debt is an allowance account? That's some new fancy kind of account?
It's a newfangled thing.
Okay.
Yeah. So just like when we were learning fixed assets, we created accumulated depreciation. We've created this allowance for bad debt account.
Got it.
Okay? So let's say time goes on, and did I put my other markers away? I did. Why, I don't know. Time goes on, and somebody ends up not paying us. Right? So we have one invoice, the guy goes bankrupt, and we know we're not going to get paid $10. Do I come down and I need to remove it out of my accounts receivable, right? Because I know I'm not going to get it anymore. So I reduce my accounts receivable. Is that now an expense?
It is an expense.
No, it was an expense long ago when I recorded the estimate. So instead of adding it to expense again, I reduce my allowance. Okay? You see it?
That's when he, yeah.
Okay, so I recorded the sale in January. I recorded the bad debt expense in January. And then in March, he doesn't pay me. So in March, I write off his account, and I reduce my allowance for bad debt. Because it was an expense way back in January.
Yeah, so this all works basically the same way as deferred payment.
Exactly. Exactly. Now, look at this for just a second, though. Before I wrote off the bad debt, my net realizable accounts receivable was $960. Now, afterwards, I have, what's the balance here? $990 and $30. What's the balance in my net realizable?
Still $960.
It's the same.
So what if those other 30 happen to pay you? Do you do the opposite thing?
Well, notice that this is March when I'm recording that, writing that one off. So there were sales in February that I needed to record an allowance for, and then there'll be sales in March, and this will roll on through time. So there's a couple of ways of estimating this, which is what I'm going to get to next. And one of them, you look at this for reasonableness, and the other one you adjust to a calculation every month. And that's how you true it up, and you keep it as close to accurate as you can get it.
Okay.
Okay? Yes, ma'am.
You might actually get to this, and you might have already said it, and it just zoned out, I don't know.
You zoned out? Ow,
Sorry.
man.
Own up to that one just in case. Shit, I can't remember what it was. I'm really tired.
See, I didn't want to answer the question, so I threw her off track, and now I'm set.
Would you, let me see. Now you got me all frazzled here.
No. Okay. When it comes to you, stop me, okay?
I will.
But I think I'm going to answer it in a second. All
I
right.
think you are too. I'll wait it out.
Okay. So that's the essence of how this works. Now let's dive into it. Before I? Okay, go ahead.
What does the X means?
Oh. Negative assets. What's XA? What's the book use XA for? You're going to ask me this, and I'm not going to know. Expense? Is it an expense? Could be. Yeah. Well, here's your expense account up here, plus E. Expense accounts end up affecting stockholders' equity through retained earnings. I get that one. I don't know what XA stands for. I'm drawing a blank. Yeah. Okay. All right.
Is that what it means?
Is it what?
Is that what it means?
Must be.
For the-
Oh, yeah.
Yeah.
Yeah, for doubtful accounts.
Yeah. According to our expert. All right. So on the balance sheet, you show accounts receivable less your allowance, and you end up with net realizable accounts receivable, which is what I was doing over here. I should write this a little bigger, shouldn't I, for those of you in the back? Say yes? No? I did that to you on purpose. What do you want me to do? This? Does that help? It'll just mess somebody else up, right? Okay. So this is the amount we expect to collect, or the $960 in the example we've been working on. Good? Yes, ma'am.
I have a question about taxes. So say you provide a service, like a veterinary service, and someone says they're gonna, like you've already spent supplies, the doctor's time, blah, 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 and then the person never pays you. So that's all a bunch of expenses. At the end of the year, can you write that off?
Well, those are all normal expenses that you're going to deduct anyway. And then you are just not going to report that revenue because it's bad debt.
Yeah.
You're actually going to report the revenue as $1,000, and then you're going to have a bad debt expense for the $40 here.
But you're out of profit, but you spent money on the
Right.
expenses.
So you didn't just lose the $40, you lost all of the expenses that go with it as well.
And you can't write that off on taxes?
Yes, you do. Yes. Okay. All right. Anybody else? Blank stare? No. Okay. So, here's the next step. When we identify the person who's not going to pay us, remember I did this over here? We're not going to get paid. So I reduce from the accounts receivable the $10, and I debit the allowance account. Remember, you do not go to bad debt expense a second time. That's all they're showing us here. What I want you to remember is you do not go to bad debt expense a second time. Good? Promise me you won't do that on a test? Say, I promise. Okay. You will have the opportunity to do it on a test. Please don't. Okay? All right. All this is showing you is that the net realizable amount remains the same before and after. We already covered that. Good. All right. Oh, this one? Yeah. I got screwed. They didn't pay me. Yeah, God. You know, Christmas is coming up. I got to buy the G.I. Joe with the Kung Fu grip for my kid, but now I can't. You know, you see this whole, right? Okay. So to answer your question from earlier, there's a couple of ways to calculate this. I've seen all kinds of ways to calculate the estimate of the allowance account. There's a couple of primary ways that it's done. I'm going to cover those. The first one is as a percentage of net credit sales. I'm going to slide all the way over here. Remember, we had sales, less returns, less discounts gives us net sales. Now, did we sell all of this on credit? No. We only sold part of it on credit. So in this example, you just take the amount that you sold on credit, not to credit cards where you actually gave them terms, and you multiply it by a loss rate. Now, companies track this over time, and oddly enough, the percentage doesn't change, hardly at all. It becomes a very consistent thing. So you apply the historical percentage that the company's calculated forever, and you come up with your bad debt expense for the month. Good? Remember, net credit sales, not all sales, not even net sales, net credit sales. Very specific. Questions? Yes?
Are you constantly changing it, or are you constantly adding?
The percentage?
No, the bad debt expense.
The bad debt expense, you're constantly adding to it. Under this method, I'm going to do a little erasing. Okay? Under this method,
It's going to be a different number each time, right?
right. So let's say in month 1, my expense is 40, so my allowance goes up by 40. In the second month, I calculate that my expense is 30, so my allowance goes up 30. All right? And as time goes on, I'm identifying, okay, this guy's not going to pay me. Okay, this guy's not going to pay me. Then the next month comes on, and maybe it's another 50. So this is going up and down and up and down. And it should hover at a fairly consistent rate or balance, with one exception. If your sales are increasing, I would expect this to increase over time also. Right? If your sales are flat, I would expect this to be flat, and so on. Yes, sir?
So if someone goes into ProBuild and opens an account and then has the account for an extended amount of time, and they're in like the tier 2 pricing where it's $10 less.
Yeah. Yeah.
And after the 30 days that they're supposed to pay off their account for the month, they pay it on credit card.
Okay.
And then, or say they don't pay that account. What I'm trying to get at is, if they're already getting $10 off on the item that they're buying, and then they don't pay that debt after 30 days, how does that company account for like the discount and the bad?
Well, I don't have a bad debt yet. It's only been 30 days. And, so you start calling them up. Hey, I need you to pay this. Do you remember? You're a good customer. You remember you owe me this money, right? We're okay. Yeah, you're going to pay me? Okay, cool. So they'll promise you they're going to pay for a while. Right? Hey, I'm sorry, I forgot it last week when I ran checks. I'll catch you next week. Or something, right? And that'll string out for another month. So now you're at 60 days. And then, what do you do then? You keep calling them, and then you send them a letter saying, hey, come on, here's a copy of the invoice. You really owe me this money. Maybe you start getting nasty with them. If you don't pay this, I'm going to call my attorney, right? So that strings it out another month as you guys go through that. So at a minimum, by the time you figure out he's not going to pay you, you're 90 days down the road, at a minimum. And it's usually longer than that.
So it's kind of on an individual basis is how businesses are
Right.
going to come up with the
Right.
numbers.
Okay? Yes, ma'am.
Just when you were doing the kind of how it was accruing over a couple of months, does that mean that the bad debt expense account stays up like a permanent?
Well, it's an income expense. The allowance is a permanent. The expense is an income statement account, so it's a temporary.
So that would be zeroed out?
It gets zeroed out every month.
Okay.
Okay? Yeah. Other questions? Okay. So, example of this. Here's a company that sells kids' clothing. $600,000 of credit sales, net credit sales. Our bad debt percent has historically been 1%. 600,000 times 1%. I figure that I'm not going to get about $6,000. Good? So I record the entry, bad debt expense debit, allowance for doubtful accounts credit, and I move on. It has nothing to do with identifying specific accounts to write off. Okay? Yes?
Different note. If everybody, they wouldn't pay off their accounts receivables, then you have this account full of money.
Yes?
You just hold on to it?
No.
You transfer it
No.
somewhere else?
You look at it for reasonableness. If my accounts receivable is 0 and I have a balance over here, I need to get rid of it. Okay?
And that percentage is something that just
Very consistent.
from the time the business opens until forever. And it's going to take, like, if the business has been open for 10 years, it would take essentially 10 years to really change.
It could change overnight. You could have a huge economic event, that kills a certain industry, like construction. All of a sudden, the construction guys aren't paying you because you own a ProBuild, right?
Yeah.
Got a problem. So this could change, but typically it's consistent as long as you don't have a major hiccup in the economy. Okay? All right. Method number 2. Aging accounts receivable. Has anybody seen an accounts receivable aging? Anybody? Usually somebody. Sean has, I know. You have. These are a little bit more sophisticated. What we've been doing so far is you take net credit sales and you multiply them by a number. Bang, you're done. It's quick, simple, dirty, and you're on your way to the next project. An accounts receivable aging gives you a lot of information. It lists customer, A, B, C, D. And then it tells you how much they owe you and how old it is. Is it current? If it's current, that means it's between 1 and 30 days old, right? Because they shouldn't have had to pay it yet. If it's between 31 and 60 days, then it's overdue. They owed me this money before, right? Then it can be 61 to 90 days. This is where I'm really starting to get worried. Then you get, greater than 91 days, and, I'm really, really starting to get worried. Sometimes you see even more columns out here. You'll see a greater than 120. So let's say this guy just bought something the other day for $600. He doesn't owe it yet. He just bought it the other day. This guy bought something last month for $400. This guy bought something for $200 long ago. And this guy bought $100 worth of stuff that he just hasn't paid me for. Okay? So this is what an accounts receivable aging would look like. So you get these totals. Now, this is $1,300 worth of stuff. In our first method, taking net credit sales, you'd multiply this times a percentage. The same percentage for all of it. But we're going to get a little more sophisticated here. If it's current, what do I think my odds are of collecting this? Pretty good. So I'm probably only going to have 1% of this be bad, typically. If the guy's, owed it to me for more than, if he's beyond terms, so, he's owed it to me for 40 days, it's probably a little more risky than this. I'm probably only going to see 97% of it, right? 3% of it's probably no good. If it's been floating around for 60 days or more, I'm probably not going to see, say, 5% of it. Out here, there's this magical number. Once you cross this thing, and it's usually this one or this one, every company's a little different. Once you cross the magical number, these things start to do this. It's kind of scary. That's why you want to stay on these people and get them to pay you as soon as possible. So in an aged receivable calculation, you line everybody up in their category, and you apply the historical percentage to each of these accounts, or each of these totals. So this is $6. This is $12. This is $10. This is $50. So in this case, everybody see that? Everybody see what I just did? So in this case, $60, $72, $78 is my allowance for bad debt. So out of my $1,300 in receivables, I don't expect to ever see $78 of it. Good? Okay. Now here's where this one's different. I need more board space. I'm going to do it right here. My allowance account. Somebody pick a number. What? 7? Let's say that account has $7 in it. My allowance has $7 in it, and I calculate $78 with my aging method. I want to adjust this balance to be $78. So I need an entry for 71. Everybody see that? And bad debt expense down here would be 71. Why? Because I consider this method to be more accurate than the other method. Therefore, I'm adjusting to the calculated balance The other one, remember, I was just calculating an expense number, and I was coming up here and I was adding, $40 or $30 to it, and just adding that to it. This time, with the aging method, I'm actually adjusting to the ending balance. So please make sure you do that one right on a test, because that's the trick here. The other one is using net credit sales. This one is adjusting to the ending balance. Good?
So you can use either method.
Well, I'm going to tell you which one to use on a test. Okay?
You're going to tell us now which one you're going to use?
No, you'll use both on a test. At some point, you will end up using both. Fair enough? I use this one. I like this one. I think it's a little more accurate. But some people, some companies don't invest the time that this takes.
A computer program that popped out.
Programs do it, yeah. Computers are great. Sir, what can I do for you?
So what you're doing with 71 is that you're zeroing that account, right?
Nope. I'm making the balance in the account
Be the allowance,
equal
be the expense.
78. Notice now these are the same. Okay? So if this balance had been 20, I'd be posting 58 to make it 78. What? Yeah, whatever this number has to be to get to 78 is what I'm going to post every month. So think about this. Let's get crazy for a second. Woohoo! Let's say I underestimated last month and I actually have a balance over here. How do I get this to be a 78? I need to go all the way to 88 to get me here. No matter what, you want to get here. Good enough?
Yeah.
Questions? Answers? Moving on. Oh, the book's going to show us how to do it. Okay? So they've got some data here, and they do the math, and the estimated uncollectible amount is $1,201 in this example. We're going to adjust to 1201. No matter what, okay? So, okay, we have a balance of $50 in that account. We want it to be 1201. We need an adjustment of 1151. Bad debt expense 1151. Allowance credit for 1151. And your balance is now 1201. Good? Pretty exciting. Hey, by now you should be doing cartwheels, Anybody wants to get up and use the aisleway down the middle, feel free. We don't charge extra for that. There's an allowance for that, yes. All right. So, they're just showing you again. They're showing you what I showed you. If you have a debit balance, you still have to adjust all the way to the credit. If you have a credit, you just adjust to the credit. Okay? Don't forget, you're always adjusting to that ending calculated balance with the aged receivables method. Cool? Cool. Okay. A new ratio. We love ratios, yes? Yay. You guys are getting as sick and twisted as I am. That's great. That was my goal? No. Okay. Receivables turnover. This is how many times you collect your receivables on average during the year. So net sales, remember net sales is sales less returns, discounts, gives you net sales, divided by the average trade receivables. How do you get average accounts receivable? Beginning plus ending divided by 2. Good? Rocket science, right? Okay. So we have $689 in receivables, and $72 at the of AR at the beginning. Sorry, $689 in sales, $72 of AR, and $108 of AR at the end. Do the math, you get 7.6. So, the question is a 7.6 better than a 6.7? Or is a 6.7 better than a 7.6? Which one is better? Right. What this is saying is I sold things and collected the money 7.6 times during the year. So, assuming every sale has a profit built into it, I would have more profit here than I would over here, right? Cool. I'm also collecting my money faster over here. I'm collecting it 7 times a year instead of 6, meaning the number of days I wait is shorter. And you need cash, so the faster you turn over your cash, the more efficient you are, the less likely you are to be borrowing money from others. Questions on that? All right. So the next one is, we take that number, that 7.6 number, and we divide it into 365, and it will tell you average how many days it takes you to collect the money. And in this case, 7.6 is a 48 days. So people are paying me on average every 48 days. Is there room for improvement here? Maybe. Maybe my terms are net 45, which they probably aren't. But if my terms are net 30, I got room for improvement. If my terms are net 10, I'm probably going to get fired. Okay? So you can evaluate how your accounts receivable function is performing here as well. Good? Questions on this? I think it's funny too. Yes. All right. So, as I said a minute ago, the more often you're collecting your cash, the fewer days it's floating around. As we showed you over with our aged receivables, the fewer days implies less risk, greater odds that you're going to collect all of it. It also is a matter of cash flows, right? Every time you collect the money, that's cash coming into the business. Remember what our fourth financial statement was? The statement of cash flows? Good. So, anytime you do sales on accounts receivable, think about it. If I do a sale on accounts receivable, did I get the cash? No. So it doesn't show up on my statement of cash flows until I actually get the cash. Good? So this goes back to when I was saying cash is important. In the accrual method, you can make a whole ton of sales, and if you're not collecting the cash, how do you pay your bills? I have a net profit though, because I'm making a bunch of sales, right? So I'm profitable, but I'm going to go out of business because I don't have any cash to pay my bills. Fair enough? Okay. All right. Here's fun. Here's exciting. Cash equivalents. Anybody heard this term before? Tell me about it.
Things that can become cash very quickly, so things that are very liquid.
And therefore are considered equivalent,
Yes.
or the same as cash.
Yes.
There are some examples up here. A check. Remember earlier we didn't want to take checks. Here they are. If somebody gives me a check, theoretically I could go to the bank and cash it and turn it into cash. Nothing. No cost, no barriers, nothing to hold me back. A money order, same thing. A bank draft, right? Cashier's check. Why would they list T-bills? Because it's guaranteed by the government. All right? Everybody good with this? So those are cash equivalents. Okay. What's the thing most likely to get stolen out of your business? Cash. Okay. What?
Time.
No, they're going to steal cash.
Depends on your employees, I guess.
No, trust me. If you had a time card that they could fill out with any hours they want, or a pile of cash, which one are they going to grab and run for the door? Okay? They're going to grab the cash. After that, the next thing they're going to steal is inventory, things that they can sell to somebody else and turn it into cash, right? So take care of your cash. There's a great discussion in the book about it, but separate duties, put somebody in charge of, keep it locked up sort of stuff, common sense things. The fewer people that have access to it, the better. If you own a retail store, you count the cash drawers at the end. You see who's, instead of putting it in a drawer, putting it in their pockets. Maybe you put up cameras up in the corners, stuff like that. Good? Bank reconciliation. Anybody done a bank reconciliation? Yeah, who said yes? Come teach them. I'm tired. It was horrible. They're not horrible. Okay. When you leave this class and you get out into the real world and you get a job, one of the first things they're going to assign you is bank reconciliations, because they're not that hard. Okay? If somebody's taken the time to show you, if they just go, hey, here, you do this, you're screwed. Yeah. And we're recording that, and I said that. Okay, so we're going to talk about bank reconciliations in a minute. But here's other safeguards that they put in place. Anybody worked at a company where if you bought something, you had to have a manager sign off on it, right? That way, not just everybody is running out buying everything they want. You're spending all the company's cash. Checks are always pre-numbered, so if they're missing or somebody's stolen the checks out of the locked drawer, lock your checks up. Do they set it up so any employee can sign the checks? No. May as well write yourself a check for cash, right? It's like leaving cash on the table. And always deposit your money as quickly as you get it, every day. Bank reconciliation. This is the last subject. We're going to finish this. We're going to go home. Okay? That's for you, just because we all love you. Okay? So, all right. This is going to be a weird question. How many of you have bank accounts? Okay. Does anyone here still write checks? Very much fewer hands, okay? Most of you go swipe your debit card, right? I'm done. I'm moving on. So, does anyone here keep track of their bank balance, right? You have, as you write checks, you write down and everything that you spent, you keep a balance so that I can spend more checks, right? Or I can spend more money. The alternative is you write checks until there's none left, and you assume, as long as there's checks, I must still have money, right? Okay. You either are one of these people, or you're married to one of those people. So sorry, I digress. So I got to write. I can't. Check register. A check register is simply check number, date, who it's to, amount, balance. Okay? We open the account. So we open an account, we put $1,000 in. Then we come and we write check number 1 on some date for rent for $600, and our balance does what? It goes down to $400. Okay? And then we go to the grocery store and we write check 2. Safeway, who sold to somebody else. There's $100. Our balance goes down to $300. Okay, maybe we make a deposit. Either way, we come up with a number. Good? At the end of the month. So then the bank sends us a bank statement. And the statement shows, here's all the transactions and here's what your ending balance is. Does their ending balance always match mine or yours? Does it ever match yours? Almost never, right? And the reason why is, if you wrote this check on, say, January 31, and they run the bank statement that night, has this already gone to the bank and cleared the bank and shown up in your account? No. So the bank doesn't know you've written this check to Safeway. So they may have a balance of $400 and you show a balance of $300. So a bank reconciliation is where you sit down and you go through the process of identifying the missing items and making sure that your $300 really equals their $400. If that makes sense, right? Okay. So, a simple bank reconciliation starts with, I always start with my stuff. Here's what I have as a balance, $300. Do I have any deposits that I've made that the bank doesn't show on their statement? Right? If I made a deposit on the 31st, it may not be on the bank statement. So I would need to add that deposit. Have I written any, oh, let's see. Are there any service charges, right? Banks are always charging you a fee. And if somebody wrote you a bad check and it bounced and you don't know about it, well, it's on the bank statement. You got to record it and subtract it from your balance, right? If I made any math errors, I've got to fix those. And then I come up with my adjusted balance. Simple? Simple. Then I go and take the bank's balance, and their balance was $400. Did I make any deposits that, I show on mine, but they don't show on theirs? In this case, no, but maybe you'd have to add something. Outstanding checks. Well, I have a $100 outstanding check to Safeway. 400, subtract 100. Did the bank make errors? Does this ever happen? Yes, it does. I can tell stories about this. It happens way more often than you'd think. Even though they have a computer and it must be the computer's fault, it's somebody sitting there doing this that made the mistake. So if they made a boo-boo, you've got to adjust for that. Do the math and you figure out the adjusted bank balance. Well, if you adjust yours and theirs, these two bottom numbers are going to be the same. And that's when you know 300 equals 400 and you've proved something really miraculous and life is good. Okay? Everybody's looking at me like, all right. You done yet? Questions on this?
Are we going to go through an example?
We should definitely, there's one in the homework. I'm going to let you guys tackle it. We'll do it in class. All right? Yes?
Where would you record the service charge for balance check? Would it be in other or miscellaneous expenses? Like in your income statement?
Oh, what general ledger account would you put it in? Typically I have a bank charges category, bank fees, and it goes in there. But I'm more worried with the format right now. Okay? So, but think about it. If the bank charged you a service charge and you didn't know about it, you're going to have to subtract it from your balance to get to the correct balance. Good? There's a couple more slides. Don't be putting your stuff away yet. Okay. Other questions? All right. Now, everything that the bank knows about that's on the bank statement, you've already recorded those in your books somewhere. Probably. It's the stuff over here where you've got a service charge or an NSF check or an error. These aren't in your general ledger, and you need to make an entry, an adjusting entry, to get your ending balance in your general ledger to be correct. So you end up doing an adjusting entry on your worksheet for these items in here. Good? Okay. When we do the homework problem that has one of these, we will actually go through and post the adjustments so you guys can see it. Okay? I don't want to tackle one of these now because we'll be here all night. Fair enough? We're going to do a quick one here, though. All right. They're going to give us some data. Let's walk through this. July 31 bank reconciliation. The statement indicated a cash balance of, the bank statement has $9,610. The general ledger has $7,430. I'm going to actually write this on the board because this will actually go a long way. Most people do bank reconciliations, books, bank. They do a top and bottom. I do side by side because it makes things pop out that you can see easier. So I'm going to have begin, balance, books, bank. So this tells us the bank has 9610 and we have 7430. Are they the same? No. Got a problem. Okay? So let's walk through this. We have outstanding checks. Outstanding checks are checks that we know we've written, but the bank doesn't know they're out there yet because they haven't cleared, right? So I would need to take those outstanding checks and subtract them from the bank side. Everybody follow me? $2,417. Subtract. Oh, this guy's smart. He gets his deposits and he mails them to the bank. Anybody do that? Okay. So we mailed this deposit in. We know it. We have it on our records, but it's not on the bank statement. So I have a deposit in transit, and I would need to, do I add that to the bank balance or subtract it from the bank balance? Add it. So I'm going to add $500 to the bank balance for that deposit in transit. I have a non-sufficient funds check. Somebody bounced a check on me for $225. You can tell I love that person, right? So I'm going to write down NSF check. And how do I know that there's an NSF check? It's on the bank statement. So the bank already knows about it, yes? But have I recorded it anywhere? No. So I need to subtract the $225 from my side. Okay, follow me? The bank statement showed $30 in interest earned on the bank balance for the month of July. How old is this example? I need say no more. Interest earned. So does the bank know about the interest? Have I recorded it anywhere? So I need to add it to my side. Check number 781 for supplies cleared the bank for $268, but was erroneously recorded on our books for $240. So I have check 781, $240 cleared, $268. Let's assume the $268 was correct. Okay? If it's wrong, then the bank made a boo-boo, and I got to call them up. But let's assume it's our mistake. So what do I need to do to our side? Subtracting $28. A $486 deposit was erroneously credited to our account by the bank. Woohoo! Don't tell a soul. But do we have it recorded anywhere? No. But it's erroneous. We're going to call the bank and do the right thing and tell them to subtract it from the balance that they show. Okay? The other option was to add it to our side and pray that they never figure it out, but they will. So Acme, check. So I subtract that from the bank's balance. Good? Questions? Moving on. Oh, look, now they show us. There's a top and bottom. I'm going to come over here and I'm going to total these. Somebody help me out. Can somebody do the math for me? 7,177. Anybody added this side up? I'm betting they're the same.
Well, that's actually $7,207.
Louisa, you messed me up by $100.
507.
Now it's 07?
207.
7207.
Okay, 7, 2, 0, 7, 7, 2, 0, 7. Does everyone agree that that's the ending balance?
Sure.
Okay. So what I've done though is I've adjusted our books. I've accounted for the differences on the bank side. Once you do that, you end up with the same number at the bottom showing you that your account reconciles with the bank and your balance in your general ledger is okay. The balance in your general ledger should also at that point be $7,207. However, we know that it's $7,430 and we need to go in and make entries for these items to adjust the balance to the 7207. So we would end up writing a journal entry to post these things to get the balance to the right number. Good? Questions, anybody? Yes, sir.
So when you're writing a journal entries are supposed to be affecting two different accounts, but that seems like it's only going to be affecting cash.
No. Let's do this. Let's write the entry, okay? So, NSF check. So I've got a, let's call it a bad check expense.
Oh, yeah, this is going to be affecting all kinds of other stuff.
Okay? So I've got a debit for $225. I've got interest earned of $30. And then I've got a, whatever this was to, let's call this office expense, okay? Office, $28. And then the difference is going to go to cash. What's this? $223. Reduces the cash balance from here to there. Bang, you're done. There's your entry.
Okay.
Okay?
Cool.
So you post this. Your ending balance becomes this. You double check it, make sure it does. Good to go. Okay? Everybody comfortable with this? Questions on any of it? Yes, sir.
I was just curious, where did you get the 2417?
2417 is given right here.
Oh, okay.
Okay? So there's your journal entries. Bang, bang, bang. And what are we doing now? Oh, that's separate. All right. Everybody record the revenue, expense, affect cash. You end up, they did it in 2 entries instead of my 1, but you end up in the same place with your ending cash balance being 7207. Fair? Please do. Yes, she does. She just doesn't want to admit it.
Now, when you do your bank reconciliation before you do any of your closing entries and all that, I mean, I would.
Not necessarily.
You would have your bank statement.
There it is.
Depending on when you do.
Typically, you don't get the bank statement for 3-4 days. Of course, in the modern world, you get online, you print it out right now, and off you go. But you want to expedite closing, so you work on the things where you have the data and you can do it, and you get to this when the statement comes in, or you print it offline, and you can do it first. Doesn't matter. Okay? Okay. I got a laugh out of somebody tonight. All right, questions? Any other questions? All right. I know it's been fun, but I got to throw you out now.